Our perception of money is changing rapidly, and banks are at the center of all of it. From how we access it, to how we buy, to how we trust that money will be there when we need it. I'm Kiah Haslett, the creator of Fintech Takes Banking. Here on Bank Nerd Corner, I talk with bankers, economists, academics, and more about the complex dynamics shaping the financial services landscape. This week on Bank Nerd Corner, I'm joined by my friend Alex Johnson, the creator of Fintech Takes, for our monthly download and recap. This was the first time we've ever recorded together at the studios of Canapi Ventures in Washington, D.C. We were in town for our first Fintech Takes Coworking Day. Alex and I talked about emerging themes in bank deals, including Fifth Third's recent announcement for Comerica and why bullying worked, how different regulatory and legislative proposals are slicing and dicing the interests of big banks from regional and mid-sized banks, and finally, the only good application of the blockchain. Banks worldwide use Tactile's AI decision platform to power their credit, fraud, and compliance workflows and adapt them in weeks, not months. Built for banking, Tactile's platform is transparent, audit-ready, and made to test and optimize decisions continuously. Learn more at tactile.com. Hey, Alex. How are you?
I'm so good, Kiah Haslett. It's great to see you in person.
Yeah, it is wild seeing you in DC, and I'm also in DC. What are we doing here?
Well, so we are here for a number of different things, including the first ever Fintech Takes Coworking Day, which is tomorrow. Very excited about that. We are also going to be hosting like a networking reception because we do this now.
Yep.
With our friends at Canapi Ventures, who are also hosting us to be able to do, I think, if I'm remembering right, the first ever Bank Nerd Corner that you and I are in the same room for. Is that true?
I think so. We have definitely been on stages together. That have been recorded.
Yes.
And we have been, you made me wake up really early a month ago and record a podcast with you.
What's funny about that is the podcast audio was not good, so no one will ever hear that conversation, but I can say confidently that you were very sharp
for nothing. Okay.
Yes, correct.
This is me learning that.
Yeah. Like, right, surprised you on the podcast, that was for nothing. But this one won't be. I'm very excited. I also am happy to be back now that you've seized the means of production for this podcast. Congratulations.
Welcome to the guest chair.
It feels good. I'm on the right side with my right hand in the right spot, so that's great. Delighted to be here. I feel like all the pressure is off. This is so fun.
Yeah. The outline was done more than 24 hours in advance. We're both in the same place.
So you're saying that like now that you've taken control, everything is just vastly better
organized? I don't want to overpromise, but let's start with that. Also, I don't want to jinx myself, but I'm an extrovert and I'm wondering like exactly how big of a menace I'm going to be tomorrow, distracting everyone from their work. But I assume that that's what we're kind of here for, is to kind of have this cross-pollination conversations where we're out of our silos a little bit and we're just overhearing what everyone else is working on and then distracting them from it.
I'm old and I worked in an office before that was
I'm
like
familiar with
out.
That concept,
yeah. And I remember a lot of that. I remember a lot of like someone grabbing you in the hallway, someone being bored and wandering down to your cubicle. Like there's a lot of distraction that happens when you're all together. I actually think my pet theory about co-working and work from home and all that kind of stuff is like CEOs hate work from home because they sort of imagine the worst case scenario, which is you sitting on your couch like playing video games.
Right.
But I think it's actually mostly the best case scenario, which is I have nothing to do but work all the time. Working in an office, man, it's like, it's distracting, it's fun, it's chaotic, it's hopefully going to stimulate like creativity and synchronicity. I'm looking forward to it, but it'll be a very big change from just being chained to my laptop all day.
And if I don't get my work done tomorrow, it's the only time I can blame other people for it.
That is true. Yeah, we have a member of the Fintech Takes network who came up with this idea. This is entirely Rashid's idea, and it's a brilliant thought to bring people together, but we also are going to blame him if we don't get any work done tomorrow.
Well, it's once we're not traveling to a conference, but you just came back from a conference, right?
I did. I've been living in Salt Lake as like my second home.
Your second home.
Yep. It's kind of the new fintech capital of the U.S., which is great actually because it's the only place I can get to with a direct flight from Montana. So I love it. And I was there for the AI Native Banking and Fintech Conference, which is not the greatest name, but it is a great event.
How was it?
It was fun. You're familiar with, although I don't think you've met, our new comptroller of the currency, Jonathan Gould. He spoke.
That's cool.
Did a Q&A, and it was really interesting. There was a whole bunch of different topics. There was risk-based supervision. There was debanking. There was banking as a service. There was, of course, AI and model risk management. So like all of that stuff came up a lot. He was very candid, which I appreciated, especially for someone who's in that seat. And it was a good event. As you might imagine, like agentic AI came up a lot.
Yep.
AI for compliance was huge. That when I was looking around in the hallways, basically it was just bankers being cornered by AI compliance vendors and being like, hey, what do you think about this? And they seem to be having a lot of success. So that was good. There was also, and we'll probably talk about this in the show, but there was an undercurrent of open banking.
Good.
I think partially because Salt Lake City is also sort of like the hub for all open banking conversations.
Sure.
But also very relevant to AI because you need data to train models and to make decisions. And so the open banking was definitely a portion of the conversation as well. But overall, worth the trip.
Good. You do know that you're familiar with that I have a rant about how do you think you're going to do AI if you have bad data.
I think that was the topic of our conversation that won't be heard because the audio was so bad. But that's what we talked about in Salt Lake.
Yeah, I guess I can reuse that topic. Right. It won't be published. But the other thing too, and this is I'm like such a menace, but I really want to know if Comptroller Gould has like a burner Twitter account. And if you put me on a stage with any one of these regulators, I will be asking it and then seeing if I can try to guess.
It's a great question. I mean, isn't it almost irresponsible not to? In this day and age, when
how are they getting information if not from the people? And
the Winklevoss twins can shift public policy in a pretty serious way with tweets,
right?
And so you sort of just for job security and knowing what's going to happen at your agency, you kind of have to be on Twitter. So I am convinced that they do all have alt accounts. I found out recently that Bill Pulte's alt account is Bill Pulte. Because he just does it all out in the open.
The Jekyll and the Hyde is
just
one together.
Thing. Yep. But I think in the case of a lot of other, maybe let's call them more mainstream regulators, I do think they have alts. I don't know who they are, but I mean, you and I have a lot of anonymous Twitter accounts that we interact with, right?
Right. So it'll definitely we can sniff it out.
Yeah.
They found Mitt Romney's burner account.
Right. I mean, there's some really good investigative journalism. Yeah. So if you're ever bored and you need a topic for a future newsletter, just trying to guess, I think would make a very fun.
If any of our listeners have this information, also DM us.
Yes, we'll be cool about it, but we really do want to know. So.
Okay, so we're not just here to shoot the shit. There are some things that happen in banking that I wanted to talk about with you.
Yes.
One is big bank M&A, but M&A in general.
I'm very excited to hear your thoughts on this, Kiah.
I'm realizing now that I didn't flesh out this area of the outline, even though it's 100% my job
so you're
to
just
talk
gonna,
about bank
M&A.
M&A.
Riff on it.
No, so I have been, I don't think people know that the very first time you and I ever met, it was at Bank Directors Acquire Be Acquired. And the very first question you asked me was, why do banks sell? And I kind of had a moment where I was like, oh my God, why would I need to even explain this fundamental question to me,
someone? That was the water that you swam in, particularly in those days, right? The name of the conference was Acquire Be Acquired.
It's not that I've never thought about it, but it's it's been so long.
It's such a essential thing that's sits at the heart of how banks work and how they interact with each other.
Right.
But the reason I asked the question originally was, we were in the room, and if no one listening to this has been to Acquire Be Acquired, you should go at least once just to see what it's like. But the question that was asked, that I think is a regular question, is who's here to buy a bank, and who's here to sell a bank?
Yeah,
and everybody raises their hands when it's buy a bank. No one raises their hands when it's sell a bank.
That's correct.
But of course, then in the hallways, lots of deals or discussions around deals happen. So I was curious to understand that. And then to put like one further point on our little map here, I do remember recently reading some quotes from Bill Demchak at PNC, a bank that has made an acquisition recently.
Yep.
That was basically saying that in the 2023 spring banking crisis, PNC was sort of a narrow winner in terms of net movement of deposits, but just narrowly.
Yeah.
And the sense I got from his comments was that he sort of felt like, and I think he comes from the Jamie Dimon school of banking, we need to do everything we can to get bigger. So I guess in that context, as well as in my general curiosity about why banks buy each other and sell to each other, I was wondering, like, what's up with these large regional banks trying to get bigger?
Yeah, and that is a very interesting sub-trend that we're seeing in banking. Banks sell at like a pretty regular rate. Yeah. But post-COVID, that percentage of deal activity like kind of dropped off a cliff. And there was like some really interesting reasons why that had to do with accounting and AOCI and unrealized losses.
This isn't that episode, Kiah, just so you know.
And so the question is now, so there's been, so the question is deal activity normalizing in banking? Number two, who is buying banks and what are the trends we're seeing within that? And that question is also tied to, are regulators responding to these deals differently? Because there was this element or this perception that regulators were like an unspoken influence, an invisible hand, or in this case, maybe a gate that was preventing some deals happening.
The thought at the time, and this is like Biden era, right? Is that they're not going to be cool about it.
Yes.
Like even if you have a really good justification, even if you can answer all the questions you have to answer to go through that process, it's not going to go great.
They were kind of skeptical about, how communities would be impacted by the deals. And how the deal itself would impact competition for banking services within a market. And so you kind of saw like this, you can't really ever know because what they'll do is like just slow roll the application for M&A, or they'll say something obliquely during an exam that indicates that if you submitted an M&A application that they would find other problems within your bank. Yeah. And so the impact was that we just didn't see the super regionals participating in M&A. Yeah. And at the start of the Trump administration, Governor Bowman and, some of the incoming regulators indicated that they were going to change that. They would just have a different approach. Yeah. And I think a lot of banks are kind of testing those waters and they're finding them to be warmer, I guess, in which is a good thing in this sense. Yeah. So one of the most interesting things that we've seen is these super regionals re-enter at bank M&A.
They're going for it.
And
they seem to maybe have like kind of a wish list maybe already developed over those years of longing to buy a bank. So like these are happening pretty quick.
Right. Well, the one that just was announced was Fifth Third's announced acquisition of Comerica. Yeah. And that one's really interesting to me in part because Comerica was recently the subject of activism. So can you give me like the very basics on Comerica? Because not a bank I'm terribly familiar with. I'll just be honest with you. Not a bank I'm super familiar with too, because I feel like they've been they're not a bank that gets maybe mentioned as like a really exciting growth story. Right. You don't hear much about them. They have sort of I don't want to say it's a strange footprint. Obviously it was the right footprint for them, but it's very like not contiguous. So
where are they?
They're in Michigan and Minnesota or like the upper Midwest, and then they're in Texas and across the Southeast. So they have a very strange footprint. And it kind of came up in the deal that it just like that Comerica had below peer growth. And, the returns were lagging. And they also kind of had just a very strange footprint.
What was the rough asset size for Comerica? I'm speaking from just ignorance, Kiah Haslett.
Definitely should have looked up beforehand.
Well, and while you're looking that up, can I just say that as a side note, just so we can put it into the public record, the board game Risk, if we could like reimagine that in terms of bank branch footprints and acquisitions, I would be very happy. So like just anyone out there who wants to do that or sponsor us to do that, just let us know.
So Comerica's assets are $77 billion, which is regional, but not super regional. And then Fifth Third is $213 billion.
Right.
So this is a big deal as far as the size of the buyer or seller is, but Fifth Third is so big that I think, on the application, it's risky, but not super risky. But it does create it pushes them over 250, and that puts them in a different asset class of banks in general.
So, all right, I have two questions about that. One is, in terms of risk for acquisitions, what's the sweet spot for like size to size? Like, because Fifth Third's not going to buy a tiny little community bank.
In banking, 50% is considered merger of equals. So if you're like kind of in the band of 60 to 40, we would say that there's like maybe higher integration risk because of the relative asset size. Now, so this is good. It's decent. But
it's not that level.
It's not that level. The other thing too is, the relative experience of Fifth Third as an acquirer over time. Maybe they haven't been buying a lot of banks, but they might have been buying some technology companies.
They have been, as a matter of fact.
And then you would want to, think about the integration plan. But the whole $250 billion thing is its own. We don't have very many banks over $250 billion.
Well, that was the other question I was going to ask you is, when you say it puts them in a new tier, is that in a formal regulatory sense?
It is, and I would have to look up all the special things that come up with 250. I think there is something around CCAR, like the stress test, that they have to do it annually instead of semi-annually.
Yeah.
Obviously, the thing I care most about is that they will... the combined bank will lose its AOCI filter. It now has to include all of its unrealized losses back into capital. And so U.S. Bank was getting bullied a little bit in an activist campaign about that.
Right.
And so you just want to make sure, and I was actually looking for that information in their investor presentation. I didn't see anything. So
going back to like Comerica and what they do and who they are and where their branches are, why is Fifth Third doing this? Like the basic question, but like, are they just trying to get bigger and the like biggest is best in all cases in banking, or is there more of a strategic alignment?
I think there's definitely a strategic, why Comerica, but then there's also why now.
Yes.
And so I think Comerica's footprint is in areas where Fifth Third isn't and wants to grow in.
Fair.
So that's really great from a growth potential. All these banks have to think like, hey, if I was going to expand in Texas, if I was going to expand in the Southeast, which we know Fifth Third wants to do,
right?
How would I do that? There's a cost to opening branches and trying to hire loan teams. And there's a cost to buying. I think one reason why Fifth Third decided now is a good time is one, the relative currency, the strength of their currency relative to Comerica's perceived weakness in the market, but also that, after maybe a northeastern rival has acquired a bank in the West, you'd want to take advantage of the regulators' friendliness and attitude towards big bank M&A, which they have historically not been allowed to do.
So it's not dissimilar to like fintech companies acquiring a charter where it's like a window of time.
Yeah.
And if we don't do it, and especially if one of our competitors does it, we are at a disadvantage and the window might shut before we can do that.
And one of the things that, in banking is maybe everyone knows and maybe people outside don't know is that Fifth Third and PNC probably compete really, really hard against the biggest banks in the country.
Yeah.
The biggest banks in the country aren't allowed to acquire deposits anymore.
Right.
Outside of, I guess, failed banks. And so if you will find yourself like in knife fights with Chase Bank all the time, and Chase Bank is actively opening branches all over these United States. And so you now are like, shoot, we had a branch strategy, but it's not as like juiced up as Chase's is.
Well, they don't have the resources, right? Like Fifth Third can't build their own branches and expand the way that, Chase can. But if the branch is already built, staffed, all that kind of stuff, and we feel like we can integrate it well.
And, Comerica is seen as a big middle market bank. And so their funding wasn't as great. And so that made, they might have had more their long-term revenue outlook maybe might not have been as strong as a bank that has more core funding. So, there's, some kind of timing. There's individual like decisions on both the buyer and the seller, but there's also right now just a lot of deals in the air. Although I was looking at some research and we're still kind of not to the pre-pandemic banking activity.
I was going to say, it feels like it's ramping back up, but it's not where we were.
Yeah. And one thing that I think is interesting is that every especially with the unrealized losses, those really drag down deal prices. As people get maybe more used to how unrealized losses factor into your deal price, as your your buyer's currency gets stronger, we might just see better pricing.
Can I ask you a question about that?
You're asking me so many questions for an outlined part I didn't fully flesh out.
Welcome to being the host,
I'm having to remember this all right now. And I'm using notes that I've created for a future newsletter.
No. The only thing I was going to ask is just, so on like the book value question.
Yes.
Which you've done a wonderful job educating me on over the last couple of years. When you're talking about like maybe expectation shifting a little bit, that's one thing I'm kind of curious about just with deals moving forward is how much of it is banks getting back to a healthier position post kind of the COVID disruption that kind of threw everything off, and how much of it is buyers getting used to a new normal. And I'm in my brain, I'm putting this in like real estate context where it's sometimes like, wow, 750,000 seems high, but like then you sort of become used to, well, in this market, that's just what
your
I start
Overton window costs. Shifts.
Yeah, like the Overton window moves. So
worth.
How much of it is that, and how much of it is banks are like healthier in a better financial position?
Yeah, I think one thing that's really difficult is that there are people who work at banks today who remember like Bank of America buying banks pre-Great Financial Crisis for like 4 times book. And so
you're like, that's not going to happen.
So like everything is like kind of relative to what. So we're never going to probably get up to 4 times book before.
Right.
And when you overpay for something, you'll lose money on it almost. Like you're almost guaranteed to have it, whether or not you have a bunch of subprimes hiding in that thing either.
Sure.
And so, we had that reset during the financial crisis. And then tangible book value became really, really important because people were so scared about the credit risk hiding in banks. Now, the question is kind of whether we're past that like concern and whether we can kind of get past tangible book value. And when something sells for 150%, it means like it was valued more than its full book value.
Yeah.
Now, and so like banks kind of want that. But one thing that happens is that buyers, their currency, their stock price isn't valued 150. So what happens is maybe you're valued at 125 and you pay 150, which means now you've taken on dilution. And so you've kind of overpaid and you've kind of extended.
Right.
And that's
combined to bank on credit.
I don't want to say it's fine. It's like in banking, there's like with a range of numbers that it's acceptable to take on X amount of dilution and take X amount of years to earn it back.
Yeah.
But what happens is like that resets pricing expectation because you just can't afford to buy something that is valued at a certain price. But the seller is like, well, I'm worth more than what your stock price premium is. And in banking, we only have like, we've got 300 public banks. We might only have like a handful that are over 2 times book.
Yeah.
And we have even fewer that are over 3 times book, right? Most banks just aren't playing with they're just not highly valued in the stock market. So they can't pay a lot. And really like one of the reasons why the size kind of matters is because you can pay more for a bank that's like smaller than you, if that makes sense.
It does.
Because like if the bank is like, if the bank's asset size is smaller and there may be only 10% of your total assets, you might be able to pay more just because they're just a smaller bank from a valuation standpoint. And it makes the math kind of work. Yeah. And I think like, it looks like right now the price to tangible book value at announcement is about like 150. And so that's like, for a lot of people, that's just not really exciting.
Yeah.
And also, would you sell if you think you can make more than that, right? If like your future growth outlook higher than what you're getting today?
Well, so we can. I won't pepper you with questions. I won't pepper you with questions forever. No, but the last point I would just make about that is that it does feel like there are these like, and this probably been the subject of a lot of academic study, but it seems like there are these kind of cliffs that different size institutions get to where they kind of have to look themselves in the eye and go like, okay, can we really compete with this next tier of institutions? And to your earlier point about why neither one of us were terribly familiar with Comerica, it's probably because they hadn't been on a trajectory where it was like obvious to any observers that they were going to vault into that next tier and really like throw their weight around and compete. And so it does feel like, and this I think is the thing I'm going to be trying to pay a little bit more attention to with this stuff, where are the sort of hotspots, I guess, where different banks of different asset sizes are kind of petering out in terms of their performance. And then if those banks are kind of petering out based on their size, who does that make them a good acquisition target for? And like, obviously we know the super regionals feel like they're in a knife fight with Chase every day. They need to find a way to scale up to compete with that. But where are the other hotspots and how many deals do we see before the regulatory environment changes?
I mean, if I just had to list them in banking, they're all these goofy asset sizes. There's 1 billion. 10 billion, famously. Now that CCAR has been lifted, I would probably say the next soft one is 75 billion. And then I would say 150 and 250.
Okay. And some of those are tied very specifically to regulatory
things.
Some are a little less. Some of them are more about how your bank changes as a business when you get to a certain scale.
Yeah, and I just think that it, how we think about how does like the bank itself become more complex. And at what point, like, what used to happen is like there would be like a bunch of banks like right under 10 billion or a bunch of banks right under 50 billion. And then they would just kind of stall. And the question, and for a while it was like a mathematical thing that when you went over these, and still with Durbin, when you go over them, it's mathematical that you will need to probably hit 12 billion in order to keep your revenue at the same level it was when it was like 9
billion.
You
don't step over them, you leap over them.
But now I feel like there are maybe operational issues that at 75 you would want to be thinking like we can't live here. We're too big to play with like the community banks. And we're not big enough to compete against the super regionals, which are now like all accelerating up to 250.
Well, and I think the other thing is like not that branches and branch locations and that kind of reach and distribution and scale doesn't matter. Obviously it does. But I also think the other thing that Chase kind of teaches us is they've just been pouring money into technology. And technology is another thing I think that really separates these banks at different tiers. And if you look at Fifth Third, I think they're in some senses playing catch up a bit on branch expansion, but they're ahead of a lot of their peers from a technology perspective. And so it's kind of a question, I think, to a degree of, you have X number of dollars to play with in terms of investment. When do you want to invest that in technology? When do you want to invest that in branches and sort of geographic expansion? And if you're going to expand via branches, is it more cost effective and regulatorily approved to do it via acquisitions versus organic expansion? So one way maybe of thinking about this is over the last 4 years, acquisition expansion off the table if you're in this size range. Technology is okay. And in fact, that's where a lot of banks leaned in. And now we may be seeing kind of, I always think about like cyclical versus counter-cyclical. And it seems smart to me that these large regionals, were investing in tech when acquisition was off the table. And now that acquisition's on, maybe we'll see a little bit of a pullback mildly on tech and more on acquisition.
I mean, it's ultimately the same pot of money. And at a certain point, it's all capital. And it's like, how do I spend capital? But they are just two areas of growth. It does make sense that you would want to invest in tech when you can't buy anything, but hopefully, that whole time that those investments in technology means that you can pick off other banks that haven't been able to make similar investments, but might have enough asset size or a branch network that
or some other
and be
assets
opportunistic.
That you like.
And that's like kind of a thing in banking is and the opportunistic acquisitions.
Totally. Well, and then in theory, technology should also help with integration and those things, which I think is probably more theoretical for a lot of banks than it is actually true in practice.
Stay tuned.
But more to come there.
Also, and I'll put a bow on this, but I think the Comerica, the activist presentation about Comerica is iconic, and everyone should go look at it because that was some hardcore bullying. It was shock, and it got brought up on their earnings call, I think last quarter or the quarter before. Shocking stuff. It was so good.
Okay. Drama.
In banking, conditions change fast. Credit teams need to adapt without sacrificing credit quality, compliance, or control. That's why banks choose Tactile's AI decision platform. It gives teams the power to design, test, and refine credit, fraud, and compliance workflows using AI quickly and securely. With seamless data integrations and built-in testing, every decision flow can be optimized in real time. With Tactile, AI isn't a black box. It's transparent, explainable, and regulator-ready, so banks are always prepared for what's next. For more information, visit tactile.com. So the next thing I wanted to talk about, more bank content, because I know that people crave it.
That's why I'm here, Kiah.
Is something that has occurred to me as we've talked about 1033. And I want to pitch that to you first because I just did a bunch of talking and did this test. But
okay, pitch it
that, and this has come up before, but that sometimes there's an argument in banking that it trickles down, right? So the interests of the big banks are aligned with the interests of the small banks, and small banks should see the big banks as kind of promoting their best interests too. The interests are aligned.
Yeah.
And I feel like in 1033, that's not happening. And there is a small bank, big bank divide.
Oh yeah.
And I'm seeing that more and more. So I want to talk about this parties breakdown before I talk about my recent example.
Okay. Well, I'll go first. So 1033, I totally agree with you that I think there is a small bank, big bank fracture that's happening, right? And we saw it during the rulemaking process where all the different trades submitted comments. In some senses, they were aligned, but in other ones, they were not, right? So big banks cared about getting paid for their data. Which obviously has become a big thing.
Because they see themselves as putting it out, right? They they're giving the data.
They're kind of a net loser.
Okay.
As a data provider because they have so much data. They have
so much
customers that can get picked off, right? And so they feel like if we're sharing the data, it's a net loss for us and we should at least be compensated for that. So that's one part. Another part is from a risk management perspective, how do we manage risk? How do we manage liability? Because, they have a huge target on their back when it comes to scams, right? We saw that with Zelle, where the big banks get dragged in front of Congress. Small community banks don't get dragged in front of Congress. Chase gets dragged in front of Congress. So they don't like the sort of liability and the third-party risk management. So they make that a big deal. By contrast, community banks had much more practical concerns with 1033, right? It was stuff like, how are we going to integrate this? How are we going to build an API? Yeah. What is an API?
Yeah.
When will our core provider that never returns our calls enable an API?
And how much will it cost?
And how much will it cost? These are questions that we have. So you saw small banks have much more practical considerations. You also saw small banks really push, I think even harder than big banks did on timelines. When are we going to have to be in compliance with 1033? In fact, the final rule scoped out of compliance banks under, I believe, $800 million in assets, which those are tiny banks, but presumably they have some consumers as customers, and presumably those consumers would like to be able to share their data. But the ICBA and other lobbyists that were working on behalf of community banks successfully convinced the Chopra era CFPB that anyone under 800 million in assets, we should just exclude them. So that was pre-rule being finalized. Obviously, then the rule itself is finalized, and who sues but the Bank Policy Institute?
Okay, right. Representing the interests of all banks, right?
So they sort of like to gently present themselves when in reality, we know that BPI is very much controlled by a couple of large banks.
Sure.
And I think in the particular case of open banking, BPI has very much been doing the bidding of one specific bank. And what I've heard is that that actually really did create even more fractures between banks, right? Because not every bank is as morally opposed to open banking as PNC is. Not every bank views the sort of competitive threat posed by open banking the same way that Chase thinks about it. And, the other thing that's really interesting is, speaking of the pricing thing, not every bank, in fact, very few banks, have leverage to force data aggregators to pay them money for their data. Right. So obviously we know that Chase and Plaid came to an agreement on Plaid paying Chase for data. I have since learned that there are actually a number of sort of unpublicized commercial arrangements between other large banks and data aggregators.
Nice.
So this is not like a brand new thing. But the reality is you have to have a lot of scale as a bank to negotiate this.
Yeah.
Plaid is not going to sit down with, Big Sky Federal Credit Union, to pick on one that's in my neck of the woods. They're not going to sit down with them and go, yeah, how much are you thinking for your data? Like, that's just not going to happen because, they represent an infinitesimally small amount of their traffic. And it puts us in this weird place where now, it's kind of strange, but just envision a scenario where Chase has this commercial arrangement, but small banks and credit unions do not. If this all sticks, and there's a certain amount of uncertainty built into this, but if this all sticks, basically, if you think of open banking as a way to kind of poach customers from another institution, Chase will not have to pay for data to poach other banks, community banks, and credit unions' customers. They will be able to go on offense with open banking, and they won't have any additional cost associated with that.
And they're getting paid in open banking.
Correct. And if anyone wants to poach their customers, they have to pay for the privilege of doing that, right? And so it creates this unlevel playing field that I think really does kind of separates the haves and the have-nots from each other. And then it gets into all kinds of other things like, for example, Kiah is a data aggregator. They are owned by a consortium of big banks, but not small banks, right? And so much in the same way that EWS and Zelle kind of played out, consortiums are another tool that big banks will use to sort of impose their will on the market, including smaller banks and credit unions.
Yeah, I think in economics, there's like an action, a collective action problem. And so sometimes you're like, yeah, we need the consortium. Yeah. But we need for scale, right?
Right.
But what then ends up happening is like, maybe they're the mean girls.
Right. It's really not one man, one vote, right? In any of this stuff. It's, Chase gets 200 million votes and small little credit union gets one, right? And so it's just like, and we see this dynamic with the core providers, right? Like the cores are subject to the product requests of their largest customers and all the small ones get ignored. And so you see this in a bunch of different areas, but I think open banking has just opened up a new sort of schism in this. And we're waiting to see what the comment letters are going to be to the vote era CFPB now that they've reinitiated revised rulemaking on 1033. But I would not at all be surprised if we see a little bit more divergence than we did the last time around, even between ICBA, ABA, which kind of more genuinely speaks for a larger range of institutions. CBA, which tends to be a little more oriented towards large banks, and then BPI, which is very oriented towards large banks. We're going to see pretty different opinions. And I think, just as a final note on this, I really think that Chase and other large banks are going to benefit from being able to both play defense via fees and other things with open banking and simultaneously have the resources to play offense with open banking. And small banks kind of can't play defense or offense, which really, I think, is illustrative of like this divide that's kind of deepening.
Well, I think you're right. Okay. I think that's a fair read. And I wanted to bring up another area where I think there's a schism between the banks.
Please do.
And sometimes, I talk about the banking industry as if it's just all the banks kind of having similar policy goals or would benefit from the same way from different rules or regulations.
And a lot of times they try to hold hands together.
I think it's useful, especially when it's like external, right? So I'm going to talk about something in Congress. One of the trade groups you didn't mention was the Mid-Sized Bank Coalition of America.
I don't really know them very well.
I don't either. And if you go to their website to find their membership, what they do instead of having a list,
which would be helpful.
Which it's not going to even be that long. They have a map of America and you have to click on every single state where they've got a member to figure out who the members are.
Awesome.
But the coalition banks have an average of 20 billion in assets. Okay. And this group kind of, I don't want to say they inserted in the defense bill that the Senate is weighing right now a provision that would increase deposit insurance coverage to 20 million for non-interest bearing business accounts at banks with less than 250 billion in assets.
I'm sorry. Say that again, slower.
Okay. So, non-interest bearing business accounts that have a balance of 20 million. Yep. but only if they're at banks with less than $250 billion in assets. So not Fifth Third once the deal is approved, but Fifth Third currently.
So this would be, and obviously a lot of this ties psychically back to SVB.
Yeah.
But this is like payroll for small businesses, non-interest bearing, held at community banks.
Well,
or mid-size.
Banks that are below $250 billion.
Community banks.
Regional banks and community banks. Yeah.
No, not Comerica. They would have been way over this.
Comerica is $70 billion.
Yeah.
So they would have. No.
Oh, no, they would have.
It's $20 million and $250 billion.
$250 billion. Okay, yeah. So the Comericas of the world.
Yeah.
Or I suppose previously Fifth Third.
Yes.
Okay.
And these banks are arguing to the Senate that
in a defense bill, by the way, but we'll set that aside.
Yeah. that we should increase deposit insurance because large banks are viewed by customers, by companies as being too big to fail. And so if no one acts, what's going to happen is deposits will drift toward these large banks. And it'll especially happen if there's like a recession or something, right? Sure. Where stability becomes really important. Yeah. And so the increasing deposit insurance coverage also has like Secretary Scott Bessent is really he approves this.
He likes those. Okay.
And so all fine and good, right?
Sure.
Well, it turns out that this is slicing and dicing the banks because insurance isn't free. Famously, all the banks pay for insurance. Big banks would be excluded from this benefit, but have to be required to pay for it, which I think is really interesting. And then there's a question about a subsidy. And so we could get into the value of their the like too big to fail halo and like how much deposits that brings in and versus the ancillary supervision and compliance costs versus like what the actual subsidy, the increased deposit cost would be.
So let me ask you this question.
Yeah.
All right. So, and academics listening, study this because I'd love to have like a more defined answer. What's the distinction? What's the delta between the consumer, the average uninformed consumer's perception of too big to fail versus the actual SIFI designation of too big to fail?
Well,
like how much of a delta is there between them? Because like, I guess the point I'm kind of digging at is that I think that the halo question of too big to fail, the halo might be pretty big, right? Because like I remember referencing Bill Demchak again when he was talking about we need to get bigger. I think that, you know, PNC was a kind of net winner out of the SVB crisis, even though I don't think if PNC was just to like wildly fail tomorrow, I don't think like people who study systemically important financial institutions would consider PNC to be systemically important. So I think there is a delta between what a small business owner or consumer would think of as a big bank that the government won't let fail and is safe versus one that is like, from an academic and a regulatory perspective, considered to actually be, we have to step in and bail this company out.
Okay. Alex keeps asking me very specific questions that have very specific answers. And so I went to the Financial Stability Board's 2024 list of the globally systemic important banks, or the GSIBs.
That seems credible.
Which is like, I don't know if the overlap between them and SIFIs is 100%.
It's relatively close, I think.
And too big to fail is what we call it anecdotally. Yeah. But the list of the US GSIBs are JP Morgan, Citi, Bank of America, Goldman Sachs, Bank of New York Mellon, Trust Bank, Morgan Stanley, State Street, and Wells Fargo.
So small, narrow, not that many.
Yeah. So, I mean, and I think the operative word here is global.
You're right.
And
in
so
a U.S. context, you might expand it a little bit.
Right.
But the I guess the broader point being that, like if we were to draw the line at 250, let's just say, and let's say for argument's sake that this acquisition with Comerica hasn't closed, which it hasn't, obviously, Fifth Third's right underneath that.
Yeah.
If there's a recession, if there's another banking crisis, does your average small business owner flee to Fifth Third? Do they flee from Fifth Third? Like what, like if you're thinking about this from a policy perspective, because I don't think it's unreasonable as a fear, right? Like we saw this in the SVB days.
Yeah.
Like we saw an outflow of deposits. We saw a flight to safety.
And SVB was big, but not GSIB big.
Right.
And hadn't been flagged really as being like that if this bank failed, it would cause contagion.
Right.
Which became the concern, right?
Right. And so, like, to me, I guess I'm a little bit confused as to if you were to ask me just as a policy matter, hey, if we're going to do this, where should we draw the line?
Yeah.
Who shouldn't get this protection and who should? It's actually kind of not an easily answered question because it's more about perception than it is reality. Yeah.
Yeah. So there was a really interesting paper that came out in 2024 by the New York Fed called Tracing Bank Runs in Real Time. And they used FedWire and ACH data to identify the inflows and outflows of banks in March 2023.
Yeah.
They found that 22 banks had significant net liquidity outflows on one of the days between March 9 and March 14 that exceeded 5 standard deviations of their historical net outflows. Mm-hmm. So that could be defined as a run.
Yep.
They found that the depositors who moved deposits disproportionately fled to banks that had assets of over $250 billion in assets. And then when they looked at the asset brackets of the run banks, they found that the size bracket with the highest probability of being a run bank was one between 100 billion and 250 billion. So it's like a pretty small bracket. There aren't that many banks hanging out in that asset size.
And what would account for that being the place where the money runs from?
Well, I mean, it is close in size to SVB and Signature.
Yeah.
And then it seems like, you know, if you're worried about contagion, if you have identified Signature or SVB as being a bank that can cause contagion, but it's not big enough to, again, require like large government intervention. SVB fails on Friday without a buyer. Yeah. It's just not clear what's going to happen. You might look for similar banks, and asset size with large corporate clients is probably the easiest one, the easiest like straight comparison.
Yeah.
You know, the researchers also tried to make this argument that the banks that were the run banks also had lower capital and liquidity along with higher uninsured and concentrated deposits, which, you know, everyone acts like concentrated deposits is like super bad. And I get that it's a risk factor, but like these are corporate, like you could be a middle market, like firm, a bank serving middle market firms, right?
Yeah.
Like, and those would be large concentrated deposits, right?
Yeah. Well, it feels like part of the challenge is that, like, going back to your point about contagion risk, when there's a problem with one bank, all of its peers that play sort of the same game it plays end up suddenly looking like a risk when they wouldn't have been before. And I wonder to what degree that's more a function of this bank kind of exploded. Therefore, every bank that looks like this is also likely to explode, whether that's true or not from a first principles perspective. That's how the market analyzes it.
Why would the market analyze anything? You know what I mean? Like the market's like, I'm not sticking around to find out.
And the thing is, but like the thing about that I find interesting is, where do business owners take their information from?
Yeah.
Right. Because we were in the room together at a Alloy Labs event when a small business owner was being interviewed on stage. And there was a question that was asked of her, like, do you think at all about like your bank's stability?
Yeah.
Like, does your bank's balance sheet, does its performance matter to you at all? And like, she was very clear, like, no, I never think about that. It never even occurs to me. And so, I don't know. I mean, part of me thinks that this proposal, while I understand it, it seems more like a very hyper-specific reaction to SVB than it does like a broadly considered policy of like, this maybe is the best idea. Now, having said that, I have 2 additional questions for you and thoughts built on these questions. One is, I'd be curious what you think about the big banks being forced to pay higher deposit insurance premiums for not getting any more protection.
Yeah.
My general opinion of that is that suck it up. And the reason I say that is just that, like, you know, it goes back to the M&A discussion we were having before. You know, if you knew that you had to pay higher deposit insurance premiums, like we'll just use Fifth Third again as the example. Would they not do the Comerica deal if they found out, oh God, we are going to have to pay higher insurance premiums? Like, to me, it's one of those things where it's like, it would in no way alter your strategic planning or decision-making process. My question
is, okay, if you want...
Like, it's great to be a big bank.
If you want more insurance, shouldn't you pay for it? Why should I pay for it?
You being the big banks in this case.
In anything. If you want more car insurance, if you want to add a $1 million umbrella policy to your home insurance, if you want to have a different healthcare plan, you and I have healthcare from the same employer. Is that something that I need to be subsidizing per se? Is there a reason why the subsidy needs, like, is there a reason why you, okay, so let me start over.
Yeah.
In banking, if a bank receives like an enforcement action, it often makes their deposit insurance rise, right?
Sure.
Because the bank's a little riskier.
Right.
And if you're...
It's like a bad driver getting dinged on their insurance.
And that seems reasonable.
Sure.
Right? And so for me, you know, when I can't even touch the moral hazard aspect of this. But, you know, if we want to take the premise that more deposit insurance, higher deposit insurance coverage is often long-term associated with more risk-taking at banks.
Sure.
So if certain banks now have more deposit insurance coverage, is there a reason why those banks wouldn't be the ones that pay for this thing that they think they need?
Well, so to just like push back on your analogy, I as a driver might feel a little aggrieved, and justifiably so, if there was a class of other drivers out there who were driving indestructible cars that could never be hurt on the road, right? So like if they're driving around, and by the way, driving aggressively and cutting me off and taking my parking spot and doing the things I want to do, and their car can't be damaged no matter what happens, and mine can, I think I would feel much more charitable to the idea that they should have to pay higher premiums than I do for car insurance, right? Like, I think we have to put this in an apples to apples comparison. And then the other thing that I think is really interesting about it is, to your point about, does it generate more risk taking? I feel like all banks kind of walk around as if they think nothing bad is ever going to happen, right? I was blown away to learn just how high the uninsured deposit rate was at a bunch of banks, not just SVB, but like banks just across the board everywhere, when there are solutions, and we're sitting here at Canapi Ventures office, when there are solutions for expanding or extending your deposit insurance coverage through reciprocals and other manners. So like, to me, it's strange that like banks don't already do this.
Yeah.
And to a degree, I think it's because, and this was kind of proven out, sadly, by SVB in some senses, you know, if there's a problem and it results in like mass deposit flight or contagion, the government's going to step in and fix it anyway, regardless. So it's like, and I've seen this argument made by policymakers, like, we kind of have expanded deposit insurance coverage already, nominally. You know, is there a problem with making it official? You know what we are going to have to cut off so much of this conversation, but we have actually de facto expanded deposit insurance because the FDIC began, I believe, in 2009 or 10, prioritizing whole bid acquisition or failed bank acquisitions that took all of the deposits rather than lower, like potentially lower cost ones, bids that didn't take all of the deposits. So they were looking out for uninsured depositors. So I like, my working theory is that they changed the like calculus, but insurers or uninsured deposits used to take losses all the time, including in IndyMac and WAMU. Yeah. And like, they don't anymore. Right. And so whether or not the insurance mechanism comes through coverage, whether it comes through bailouts, whether it comes through the fact that all of the deposits will be assumed by the buyer. Yeah. All of those are different versions of expanded deposit insurance. And to put it in the context of the specific proposal, the question is, does a small business owner that has less than $20 million of deposits and is keeping them in an uninsured account, so it's not seeking like yield, it's not treasury management, it's just an operational account, like, do we think they're a sophisticated enough counterparty that they should be taking these things into consideration? And I think the takeaway, and I found this a little annoying because it was coming from a lot of like VCs and tech people, but that was the argument with the SVB thing, right? Was that, look, like, you know, over 250,000 that's a whole bunch of actually very unsophisticated parties that just so happen to have large commercial deposits. I don't know that I totally get
I want to live in a
that
world where Circle took losses.
Oh.
I want to live in that world because I want to see how, if Circle took losses in SVB, how we would be talking about stablecoins today.
Oh, I would actually love to join you transporting to that universe.
Yeah.
That sounds amazing, actually. No, it's a great point. I mean, I don't know. To a certain degree, I feel like a lot of things in policy and regulation are a question of like, do we have the stomach to just acknowledge the reality that we live in versus pretending to kind of collectively believe this fiction that's no longer actually true? And I feel like with deposit insurance, there's just a shitload of moral hazard that we're already like swimming in, and we should just sort of own up to that and live with that and accept that rather than continuing to sort of pretend like it doesn't exist. And again, I have absolutely no problem with banks that are either officially too big to fail or sort of have the sort of unofficial designation of too big to fail, paying more for insurance they don't get. That doesn't bother me at all.
Okay, so this is just what do you want to cut from this outline?
Well, all right.
How long have we been recording?
54.
Yeah.
All right, so should we do one more quick one?
Which one do you want to do?
Well, which one do you want to do?
Do you want to do this? Well,
it's your show, Kiah Haslam.
Do you want to do the only good application for the blockchain?
Oh,
the FIFA tickets?
Yeah. Let's end on that.
Do you want this to be your rant?
Yeah.
You rant against this?
Oh, do I get a rant now?
Well, do you want, I can fight you on this.
No. Well, let me
rant.
Let me rant, and then you can come in and be like the voice of semi-reason. All right.
Okay.
Okay.
All right. And Alex, I came across an article that I felt would like make you apoplectic recently. And I sent it to you and said, is this the only good application of both the blockchain and sports betting? Can you tell the listeners about it?
So I like this actually because we've switched roles. You're now the host of Bank Nerd Corner. You're doing a marvelous job. Much more organized, as we talked about. Although I think I did poke some holes in that when you were having to do research on the fly with things you put in your agenda, but we'll set that aside. The beautiful thing for longtime listeners of Bank Nerd Corner is that we would always end on a rant. And I would just say, go off, Kiah Haslam, and you just go do it. Now I get to do that. So here we go. You sent me this article, and the title is FIFA's blockchain-based ticketing system for 2026 World Cup faces preliminary probe. And I'm just going to read this portion of the article, and then I'm just going to scream into the void. Are you ready?
Yeah.
All right. For the last World Cup, tickets were put on sale via FIFA's website and allocated on a first-come, first-served basis. FIFA last year started selling so-called right-to-buy tokens, providing buyers the right to instead purchase guaranteed entry to a World Cup game. Once tickets go on sale, token holders are guaranteed the ability to buy a ticket for a specific match, even if the seat and teams playing are unknown at the time. They can also trade these tokens on secondary markets. Some of these tokens are tied to a national squad, but come with greater risk. The right to final token, for example, offers fans an opportunity to purchase a ticket to the World Cup final match, but only if the team whose collectible they bought makes it that far. With nearly 50 countries set to participate in the tournament next year, most tokens sold will result in no ticket purchases. Tens of thousands of right-to-buy tokens to date sold by FIFA to optimistic punters have to date likely earned the footballing body an estimated $15 million, The Athletic reported last month. The right-to-final England token cost $999, and those tokens are now sold out. If England makes the finals, those token holders will be entitled to a ticket to the match, but it's not yet clear how much they will have to pay to secure an actual ticket. Oh my God, I hate this so much. So now you're telling me that instead of just having a first come, first served basis, which is how we've organized sporting event tickets since the beginning of the known universe, instead of doing that, or instead of coming up with like just a randomized lottery odds system, we are going to unleash raw, unfettered capitalism onto this system so that we have some financialization where now you can buy tokens for the right to potentially buy a ticket that you might not even get the chance to buy, nor do you know how much it costs. No, thank you. This is enough to make me just want to not follow any sports at all ever again. Wow.
Okay, one, you're wrong.
Okay.
Two, this is like a beautiful application of economic design, like the market design. This is a market design failure that
this
blockchain,
thing they're doing is a market design failure.
No,
yes.
You're wrong.
Yes.
Okay, so first I need to make a disclaimer. I am a soccer referee. I referee in the United States. I also referee in the NCAA.
You've never refereed FIFA.
I've never refereed FIFA, but I need to really say before I say anything about how much I love a solution that some people are calling sports betting, that I am governed by an anti-wagering policy as an official. And so my remarks today are in the capacity of someone who just loves financial engineering. So I think this is great. I think this is a great use of options. And I think this is a great use of like blockchain ledgering capacity and the ability to kind of buy an option that you'd have to pay more in the future.
Sure. Yeah,
because the reason why this happens is like, and I had never thought about this, but buying tickets to a FIFA game, if you like a certain country, sounds like a fresh nightmare. You probably don't live in that country, and then you're gonna fly to that. You're already signing up to fly to that country, and you hope you can see the team you want to see on a date that works for you in a city that works for you, right? And these are all a bunch of decisions that will be built around your team's schedule, but you don't know how far your team is going to go. Your team only has like 3 games, guaranteed. But maybe you think your team's going to go further. So your team could have 8 games, right? Or whatever. Yep. And so you maybe want to see one of the more exciting knockout rounds instead of one of the preliminary pool plays. Sure. And so you would pay money for this. Like you're going to pay a ton of money. You'd pay money for this option. But how are you supposed to indicate to FIFA that you would, in the past, before you could do this, you had to go on secondary market totally, right? You would just have to, if England makes it to round of 8, you would have to figure out where that game is, find a ticket, and show up, right? So the problem that FIFA sees is that FIFA doesn't benefit from this.
That is exactly the problem they see.
But I don't even know how FIFA even sells the round of 8, right? Is FIFA selling the round of 8 ticket now?
I assume that they are.
They sell all the tickets all at once, right?
Yeah.
Kind of?
Yeah, I think they are. So, I mean, like, all right, a couple things on that. Very rational response. And I don't disagree that, like, ticketing these days is a nightmare, the likes of which is going to consume everyone's, like, mind and attention and sanity. I don't like it. It's very bad. But I don't think this is the answer.
Yeah, you're like defending Ticketmaster because you hate sports betting. Like,
I honestly do hate sports betting. But I mean, like, so here's a problem with this. Now these are tradable. Yeah. And now people are going to speculate on the value of them.
The market will be so efficient.
No.
Everyone who's going to be in that right to token final wants to be there and paid the amount of money they wanted to pay. The market is efficient. And FIFA would have captured the gains because, and the other thing, too, is like some of these tickets apparently are going for $30,000. So if you're willing to pay up to $30,000 for a ticket, what's 1/30th of that money now? And then if your team doesn't make it, you didn't lose $30,000. You only lost $1,000.
Right. You're describing.
You bought yourself flexibility.
You're describing how the fans are going to use this, which is great. But the problem with crypto is that it attracts a whole raft of speculation outside of the fans. So now I am incentivized to think, well, what if I bought this token because I think that the value of this ticket, should this team make it, is going to be X. And if I get that, then I can sell that ticket later to that person. Yes. And then someone else comes along behind me and says, I also think that, and I'm willing to spend more money on this. Like, this is driving up the price of these tokens, which will drive up the price of tickets in a way that is artificial to the actual enjoyment of the sport. I don't think it'll drive up
the price of the ticket. So the tokens are already sold out.
Absolutely will.
The tokens are already sold out. And
tokens are already sold out.
I think $1,000.
Just in theory, you can only sell as many tokens as you have tickets available for these matches, right?
I think you can
sell... It's not like an airline thing where they can oversell planes. They're not doing that,
I think the right to final, they could sell... Let's say they could sell the right to final tokens to 10 different teams, but only 2 teams will be offered tickets on their tokens. Yeah. Everyone else loses. Yeah. You bet on red and it was black. Yep. And then... From there,
and ultimately
if you are a token holder, you will get an option to buy a ticket from FIFA at the face price And then I don't know how reselling tickets would work.
And I presume that you still can resell your tickets, but I think the other thing is like, you have absolutely, like, what is FIFA's incentive to in any way? Because what they should do is they should cut you a break. They should keep them at face value. They should keep them affordable. Like, the whole goal is, if I buy an option, then the thing I get if my option pays off should benefit me in some way. I have a hunch that FIFA, an organization not exactly known for upstanding behavior, is probably not going to do that. And they might even like put you into a new competition that you have to then win after that. Like, I swear to God.
I'm so here for that, though.
No.
I think this is good sports betting. I think
it's bad sports betting.
It's not, number one, it's not in my stockbroker app. Number two.
That's good.
What I hope is that some of the people who bought this token and then ultimately the token pays off and then they buy the tickets are like people who really wanted to be there, and that
I think that's going to be a vanishingly small percentage
and that they
people.
paid the amount of money that they want to pay. Like, the market is efficient here. No. I think that's beautiful market design.
There's no way the market is going to be efficient. No, there's no way, because like what's going to happen is bots run by speculators are going to snap up every single one of these tokens and they're going to resell them and then resell them again at prices vastly inflated beyond. And FIFA's going to benefit, and those people are going to benefit. Fans are not going to benefit from this.
If there's no one in the MetLife Stadium for the FIFA final because the bots sold all bot tokens, and then no one ended up buying the actual ticket prices because they were too expensive,
it's just going to be
that's another good outcome. Don't you understand?
No, it is not a good outcome. Like, sports is the last thing that should be sacred and like kept away from financial engineering.
Okay,
and
you just talked about
we are bringing financial engineering into
this is some beautiful market design. Congrats to everyone who was involved.
Hate it. Hate it.
And, look for the U.S. referees, hopefully on this FIFA final, because I don't know if the men's team are getting there this year.
Oh, tough talk. I wish I could defend that, but no, I can't. And I will, knowing you and how hard you work at being a referee, I will think good thoughts for the referees involved in FIFA, even though I hate everything else about this. Kiah, a delight to do this in person.
This was great.
We had so much more to talk about. I guess we'll save it for the next time I'm on as a guest on the new Bank Nerd Corner podcast.
All right. Well, thanks so much. And thanks to Canapi for hosting us.
Yes, thank you.
Thank you for listening to this episode of Bank Nerd Corner. Stay up to date with news and trends in the bank space by subscribing wherever you get your podcasts. Also, if you love Fintech Takes Banking, please tell a friend. Talk to you next time.